Welcome back to the GoldMining Swissie case study. Today, we're diving right into week 25.
When a trading account hits major turbulence, the road back isn't exactly paved with fireworks, right? It's built on pure, unglamorous patience. So today, our focus is entirely on the actual mechanics of a gradual, steady recovery.
What we're doing here is giving you a completely raw, unvarnished look at real trading progression. We are entirely bypassing that flashy, unrealistic hype that honestly plagues the trading space. Instead, we're looking at the hard data of a genuine recovery phase, because at the end of the day, this is about real-world survival in the markets. Capital preservation? That's literally the only thing that keeps you in the game. And that brings us to our core philosophy. Trading is hard. Recovery is nonlinear. Transparency is paramount. Think about it. When you're operating below a high water mark, the psychological urge to over-leverage and just win it all back instantly is huge. But the true path forward, it requires accepting that the upward curve is going to have dips. You have to acknowledge the difficulty and maintain absolute transparency about the whole process. Let's look at the short-term victories first. Week 25 secured a highly disciplined plus 2.51%. Now, in the context of a long-term recovery, we really aren't looking for massive windfalls. We're hunting for steady, controlled, and above all, repeatable weekly progress. Getting that 2.5% gain requires tuning out the market noise and executing your strategy with absolute precision. But we have to instantly contrast that weekly win with the overarching macro reality. And that reality is a negative 18.33% total account growth. It would be incredibly easy to just broadcast a winning week, pat ourselves on the back, and call it a success. But true transparency means we never lose sight of that historical deficit. The reality is, the account is still working its way out of a deep hole. Diving into the native MT5 metrics here, that steady profit accumulation validates the $47.80 gained for the week. But honestly, the undisputed star of week 25 isn't just the profit, it's the maximum drawdown. It sat at an impressively low 3.35%. Generating profit is great, but keeping your weekly drawdown that incredibly tight, that's the very definition of defensive, recovery-minded trading. Section 1. Anatomy of the trade. Executing on USDCHF. Okay, looking at the 15-minute chart for USDCHF, you can clearly trace exactly where market opportunity met those rigorously controlled risk parameters. A solid weekly result is almost always the product of highly selective execution. We didn't try to catch the absolute bottom, and we certainly didn't hold out for some unrealistic top. We simply identified a high-probability window, executed the trade, and exited. Step by step, that is exactly how an account is rebuilt. And here's the unvarnished MT5 trade receipt to prove that the execution perfectly matched the chart we just looked at. Notice specifically the highly conservative 0.04 lot size. When you're in a recovery phase, reducing your risk exposure isn't just a polite suggestion, it is the absolute rule. Once you factor in the positive 2.40 swap, the math aligns perfectly to give us that 47.80 total balance increase. Now, trades don't just happen in a vacuum, so understanding the underlying macro context is absolutely critical. Throughout the week, Federal Reserve expectations and shifting interest rate sentiment really acted as a massive tailwind for US dollar strength. At the exact same time, the strategy had to navigate Swiss franc safe haven flows, which were driven by broader global risk sentiment. Aligning the trade with these overarching macroeconomic forces is exactly what supported our positive outcome and, crucially, kept volatility pressure on the account to an absolute minimum. Section 2. The macro reality. Zooming out. Analyzing the raw reporting data comparing long-term growth against historical drawdown, well, it tells a pretty stark story. We're looking at a historical 65.44% maximum drawdown. Confronting this massive dip visually really validates exactly why our current strategy of reduced risk exposure is absolutely mandatory. You simply cannot trade aggressively when you are managing the psychological and mathematical weight of a 65% drawdown, period. Survival has to come first. Tracking the long-term balance versus the equity rebuild phase, you can really see the slow, patient grind in action. Notice how the gap between balance and equity during those periods of turbulence is slowly closing? That illustrates the gradual rebuild back toward previous highs. It requires choosing consistency over excitement every single time. And honestly, this is the unglamorous reality of a true recovery phase. When we examine the overarching dynamics, it's pretty fascinating. The gross loss of $4,448 and the gross profit of $4,488 are nearly identical. Framing the recovery this way is vital because it means we aren't looking at a failed account. We are looking at an authentic, real-world case study in survival. The account took incredibly heavy damage, absorbed it, and is now meticulously fighting its way back into positive territory through disciplined, calculated execution. Which ultimately brings us to the core philosophy that drives this entire journey. Real accounts, real risk, real progression. Exactly. As the account continues its long-term journey toward that 10,000-cent target, remember that recovery is rarely a straight line. It's a daily practice of consistent risk management and immense, unshakable patience. So, as we wrap up, think about this. When you face your own periods of drawdown, what steps will you take to prioritize discipline over the desire for a quick fix? Keep studying the data, respect the process, and we'll see you in the next update.